right. Hello, everyone. We are now live. Tom, I'm going to go ahead and hand the mic on over to you so we can get started with this fireside chat.
Thank you very much, Charlotte. And hello, everyone. And thank you very much for being with us this evening. Tonight, we are incredibly fortunate to welcome two remarkable individuals who have made pioneering contributions to the field of finance and whose work has influenced and inspired countless people, from retail investors to industry professionals at the highest levels. My name is Tom Sweeney, and I'm Senior Vice President of Client Relations at ElliottWaveTrader. I first heard of Elliott Wave roughly 20 years ago. Now, I'm embarrassed to admit it, especially in front of these two gentlemen, but I was extremely skeptical that this was the best way to analyze a market's movements. It wasn't until I began working closely with Avi Gilburt 13 years ago that I truly realized its potential as a powerful tool for traders and investors. From a skeptic to a believer, I'm very honored to be hosting tonight's presentation. For most of you, tonight's presenters need no introduction. But if this is your first time listening to one of these gentlemen, I'd like to tell you that you're in for a real treat. Avi Gilburt is founder of ElliottWaveTrader.net, a live trading room and member forum focusing on market analysis using the Elliott Wave principle. Avi is particularly known for identifying a standardized method to trade waves 3 through 5 with extraordinary accuracy once waves 1 and 2 are in place, a method he lovingly calls Fibonacci pinball. Avi is a highly sought-after speaker by financial forums and conferences in the US and internationally, is interviewed by radio stations and podcasts all over the world, and is widely syndicated on sites including MarketWatch, The Street, Seeking Alpha, NASDAQ, Forbes, and more. Avi's first piece of advice to me, and anyone new to Elliott Wave for that matter, was simple. Get a copy of Elliott Wave Principle by A.J. Frost and Robert Prechter and read it over and over and over again. This book remains Avi's #1 recommended reading material for all new traders and aspiring Elliottians. Robert Prechter founded Elliott Wave International in 1979, where he and his team analyzed financial markets using the Elliott Wave principle. Robert has also developed a theory of social causality called socionomics, whose main hypothesis is that endogenously regulated waves of social mood prompt social actions. Robert has lectured at Oxford, Cambridge, and MIT, co-authored several academic papers, and written 18 books on finance and socionomics, including a New York Times bestseller. I'm very honored to introduce Bob Prechter and Avi Gilburt. Thank you very much for being here, gentlemen.
Our pleasure.
Really our pleasure.
Yeah. Well, let's jump right on into our first question of the evening. And that one, we'll start with Bob. And it is, how did you first discover Elliott Wave theory?
The person that got me interested in financial markets was my father. I still haven't forgiven him for it. But when I was getting ready to graduate from college, he started sending me copies after he'd read them of Richard Russell's Dow Theory letters. And I started to read them, and I was completely absorbed by them. I was also quite lost. I was, what does this mean, advanced decline line? What's that? You know, what's the PTI? And I started reading it very carefully until after a few issues, you started to pick it up. And around 1970, he started communicating with A.J. Frost. And Frost was a Canadian who used to work with Hamilton Bolton. And Hamilton Bolton had been putting out annual supplements on the Wave Principle for years to his bank credit analyst. And he began to give his opinions along with Russell's in Dow Theory letters. And that's where I first learned about Elliott Waves. And of course, I didn't know it all because they weren't teaching it all at that time. Anyway, long story short, I landed a job with Merrill Lynch in 1975 in New York City in their market analysis department. And I decided at that time, well, heck, I'm in the city. I might as well see if I can track down R.N. Elliott's original publications. Now, he self-published 2 books, each of which I believe he made 1,000 copies. And I tried the Library of Congress, and they didn't have it. And then I went to the New York Public Library, And there it was, right in the card catalog. They had it on microfilm, had both of them on microfilm. So I got them to print them out for me, and that's when I began to really dig into it, and eventually put them out in a book called R. and Elliott's Masterworks. So that's what kicked me off, and it's been a journey ever since.
Oh, that's fantastic. So same question to you, Avi. How did you first discover Elliott Wave theory?
Well, I came about it a lot more lost than Bob was. I actually started my, I guess, my learning career in college. I was a dual major of economics and accounting. Loved the economic side of the market. Went on to take the CPA exam in one sitting, then went on to get a law degree, and then tax law, a master's of tax. And I went on to become a national director and partner at a major firm where I was involved in not only running the department, but I also spearheaded a lot of large reorgs and buyouts, some of them worth over $1 billion. So I really knew how to pick apart a balance sheet. I knew businesses. I really understood how businesses work. Problem was, when I was trying to take that same skill set and apply it to investing in stocks, it wasn't nearly as successful as I would expect I would be. And after a while, you start hitting up against Einstein's definition of insanity. We're doing the same thing over and over again, expecting a different result. I didn't want to remain insane. So it led me on to a path of just seeking what is the missing link to be able to become a better investor, a better trader. And it was probably a solid 2-year process where I would try this method, that method. And ultimately, I just stumbled upon Elliott Wave International and some of their writings, some of Bob's articles, and I was intrigued. Intrigued enough to really start delving into it more. And the more I delved into it, the more it said, you know what? This is the missing link. This is the missing piece as to how to become a better trader, how to not, work on rising above your emotion in the market. And from there on, it's been a wonderful journey. And I'll sit here and I thank Bob personally when we've had lunch together, when we've emailed together, and I'll thank him again that he basically has changed my life with what he has presented in both the Elliott Wave analysis side that he wrote with Frost, the Elliott Wave principle, as well as the socionomic book that he wrote, the Socionomic Theory of Finance, which I say this over and over and over, and I could not suggest it more strongly to each and every single investor out there who wants to really understand how the markets work. So for me, it's been a journey, and I'm honored to be on this with the person who helped me with that journey.
I have to break in here because I love your story of having started out looking at fundamentals and eventually saying, let me investigate some other things and coming across technicals. I have heard from, I don't know, I would say dozens, it's probably more like hundreds of people who started out as fundamental analysts, and then they gravitated over to technical analysis when they realized the fundamentals just weren't helping them make, profitable decisions. I've never heard of anybody going the other direction. Oh, I started out as a technician, but I'm giving it all up to become a fundamentalist. I've never heard anybody say that. And then I have to add one thing as well, which is, Avi, you've been very successful at your business. You're one of the few people who have taken Elliott Wave analysis and done something new with it, which really is guiding people in their trading. Now, at Elliott Wave International, we've got a lot of people, and we've got 24 analysts working around the clock, but we don't do trading advice. We have one service that does that called Flash, but for the most part, we analyze, we say, here's where we think things are going, and we leave it up to people to do that. So, it's a real service for people who really want to dedicate themselves to trading the market all the time to have a place to go.
Thank you. And I want to add on to what Bob said before as well about, you know, the fundamental side moving over to the technical side. We have close to 1,000 money manager clients. And I mean, and again, like Bob said, probably hundreds of those, just the money managers have told me that they won't even tell their clients how much more they use Elliott Wave analysis and the technical analysis that we provide over and above the fundamentals. They'll talk the fundamentals to their clients because that's what their clients want to hear. But their decision making is all based upon all the work that we do. So it is pretty incredible that people don't go the other way. And once they come down this path, they realize this is the missing piece. It really is the missing piece.
When I was based near New York City up until 1981, occasionally somebody would come up to me and he'd start to laugh and he'd say, I was just over, you know, at so-and-so brokerage firm or whatever, or bank. And he would go in to meet with some manager and he'd say, I saw the Elliott Wave theorist on his desk. And when I came in, he slid it in the drawer and closed it. So there you go.
So I'm curious to ask both of you, because working with a lot of people that are just finding Elliott Wave theory in my position, and then they start their process. And for many people, it's a grind. You're labeling your charts. You have to go back to them. You look at them later and you go, gosh, that was entirely wrong. So just for you guys, was it something that you picked up and ran with right away, or did it take time? What was your process as you were starting to learn it? And when did it really start to say, yes, this is something? And how did that progress for you?
Well, I can tell you how I started. I started keeping charts by hand, and I was keeping gold and I was keeping the Dow. And these were days, I don't think they've been as clear since, but back in the 70s and into the early 80s, the waves were incredibly clear, at least to me. And after a few months, I said, oh my gosh, how come nobody's talking about this? This is unbelievable. There's 5 up, 3 down, 5 up, 3 down, 3, you know, 3 is where the action is and everything else. It was very, very exciting. And I had these fantasies, you know, oh my gosh, I'm never going to miss a market call because this Elliott Wave stuff is so perfect. Well, I found out eventually that it's not perfect. There are always uncertainties, and those you have to wrestle with. But I think there are 2 great advantages to the wave principle. One is you get context. So certain things don't surprise you. And Avi trades, you know, waves 2 through 5. Well, you know that wave 3 is going to be a really, really strong move. So a lot of people are like, what the hell just happened? The market just had a giant leap over a 3-day period. What's going on? You know, they look around for news and I can't find any. And of course, a wave person knows, oh, we're in the third of a third right here. And you can contextualize what's going on. And the other thing I think is an advantage is, I won't say never, but you will rarely buy a top or sell a bottom, because by the time you're at those points, the wave structure is usually very, very clear and you know that it's topping or it's bottoming. Now in the middle, there's a whole lot of things that can go on, but those are the 2 things I think the wave principle is best in terms of saving you from mistakes and saving you from feeling lost.
Avi, same to you. I know you said when you first found Elliott Wave, it made a lot of sense to you, but there was probably some areas in between there of, I first saw what this is and then to where you are now, obviously. So what was your process like in getting this? And then where was your aha moment, maybe where you said, this is what I want to do?
Well, I'm proud to say that it took me 6 readings of the Elliott Wave principle before the light bulb went on. I mean, it is a very detailed form of analysis, which is why I also say there are very few people in the world who actually will do it right and consistently right. It is a very detailed form of analysis, and it takes a lot of time to learn and actually work into practice. So I would say that, you know, after the 6th time, I was able to conceptually and actually working with it, really understand what's going on. I wasn't at the point where I was doing my own counts yet, but I was at a point where I understood everything well enough that I could actually look at a count and then start trading around that account, that count. So it takes people time. And, we've trained thousands of people through the year. And, what we've learned is that clearly everybody is not going to just pick it up and understand it a month or two later. There are some people that we have come across. I mean, a couple of our analysts, I was shocked at how fast they picked it up. For example, Garrett or Arkady and Zach and Mike, I was just shocked at how fast they picked it up. Much faster than even I picked it up, for sure. So there are some people that have their brains wired in a certain way that makes this really just almost second nature to them once they understand it. Other people, not as much. I mean, it takes a lot of time and effort to really understand this, and everybody's going to be different as to how they pick it up. Some people may never get it. And I've always said, Elliott Wave is not going to be for everyone. It takes time, it takes effort, but as Bob said, once you understand it, it provides something that no other methodology can provide in the markets, and that is market context. I think Bob said it best. Market context is what is probably the most valuable aspect of Elliott Wave analysis that will come out of.
Yeah, I've met people that just can't see it. They try and they try and they try, and maybe a year or two go by and they just say, I can't see any waves anywhere. I don't get it. I can't label anything. I've got kind of a fun story, real short story about AJ Frost. He went overseas during the Cuban Missile Crisis, and he had his secretary keep up his charts while he was gone. So he came back and he was starting to put his Elliott Wave labels on the charts, and he's squinting at it, and he's scratching his head, and his pencil's kind of over the chart, and he said, there's something wrong. What did the waves stop working properly? And she was keeping only hourly closes. She would connect the hourly closes. So he went to her and he said, let me see, how did you update this? And so she said, well, I just put in all the things. I started with the open, and then I did the 10 o'clock. He said, no. He said, you can't put in the open. He said, that's just a manufactured number. So he replotted them without the open, and he said, oh, now it's clear. I mean, it's there.
Wow.
That's
I said this earlier before we even came live, and a good chunk of the reason that I wanted to do this webinar because I wanted to listen to Bob myself.
Oh, I'm listening too.
Go ahead. Bob. Well, so we'll jump right into then to the next question so we can get more of Bob and maybe a little bit of Avi sprinkled in too.
I'm fine with that.
Who are the people that were the most influential in your career?
For me, well, like I said, my dad, Richard Russell, and I would add Bob Farrell. He's the guy I went to work for at Merrill Lynch. And the reason is I love the way he ran the department. He basically said, look, you've got certain responsibilities. They'll take you, a third to half of your day. And he said, after that, do something worthwhile. It was great. I'm a very laissez-faire person when I run my company as well. I basically try to figure out what each individual likes to do and really most wants to do. And I let them do it. I let them, put their opinions out there. And that's another thing I learned from Bob, although indirectly, because, he was a great analyst, but everybody misses him. And sometimes he would say, I think there's going to be a new high, and there wasn't a new high, and the market would go down. And I'd hear people go, yeah, I knew that wasn't going to happen. I had it. And I'm thinking to myself, you didn't write it down though, did you? He had to write it down. So that's when I realized if you try to tell people what opinion to put out there, they'll all be saying, oh, I would have had it. He was wrong, So I just let my guys go out on the gangplank by themselves. And I found out that many times they're right and I'm wrong. So it's wonderful. And one quick story about how things work. I had a guy who was a fantastic socioeconomist. He was writing really great studies. He would look at car colors going back 80 years and connect them with what the stock market was doing. And he did, air crashes and connected them to what the market was doing. All this was going back to social mood, right? So one day he came to me and he said, I don't want to do this anymore. And I said, oh, please, you have to do it. You're my best guy. He says, no, I want to be the Asian analyst. I said, we don't have one. He said, exactly. Anyway, it took him a couple of months to convince me, and I finally let him take it over. And his name is Mark Elishevsky, and he has been killer because he's doing what he loves. He used to teach in Japan, so he's got one foot in the Far East and just lives it and loves it. So I like it when people can find niches that they like, and that's I kind of learned some of that from Bob because he was a laissez-faire type of guy.
That's interesting. And to you, Avi, who are some of the most influential people in your career?
Well, as I mentioned before, Bob is definitely up there because of his groundbreaking work in socionomics and his publication of the Elliott Wave principle clearly was a major factor in the most important factor in what I'm doing now. But I will also say, when I started doing what I'm doing now, it wasn't exactly the best of situations. I actually quit working as an attorney and as a tax consultant and an M&A consultant when my wife came down. We had our son, our youngest son, who's my youngest now, and 11 days after we had him, we found out that she had a very serious and rare form of cancer. So I basically stopped working. I had three other children at the time. And now I had an infant, 3 children, and a wife who was ill. And we were spending literally weeks at a time in the hospital with her because of the therapies she was getting. And I started day trading out of her hospital room. And I joined a website run by a gentleman who's been in the industry for God knows how many decades already, Harry Boxer. And they did day trading. So Harry would call out the stocks that would be gapping up that day, and as a group we would day trade. And I'd run behind the scenes. I'd run my Elliott Wave analysis on it, and I would determine which ones I'd want to day trade and which ones I wouldn't, because some of them looked like they were just a corrective C wave up, and others were gapping up in the start of a third wave. So I'd want to do the third waves. Great. After a while, I started getting comfortable on the site, and I started posting in the chat room. And I started posting some of my analysis about the S&P, the stocks we're trading, and I started developing a little bit of a following in the website. And after a while, Harry took notice, and he reached out to me and said, "What are you doing?" So, I explained to him, we got on the phone, and I explained to him, I'm doing Elliott Wave analysis on this. And Harry had a very rudimentary understanding of Elliott Wave analysis, but he basically understood what I was doing. And, he said, I'm going to watch you. I'm going to watch you. So, we're going on for a few more months, and he gives me a call back after a few more months. And he says, "Look, you're damn good at this. You need to teach people what you're doing." So I said to him, "Harry, I just don't have the time." I told him I have an infant at home. I have 3 other children. I have a wife who's ill. We're going back and forth to the hospital. And Harry just kept pushing me and pushing me and pushing me to do it. And after a while, it was probably about a year later, we started seeing some improvement in my wife. And then, when we started seeing some daylight, she turned to me because she knew how much I love the markets. She turned to me and said, "You know what? You love doing this so much. Why don't you take him up on his offer? And why don't you go out and teach this? Why don't you go start teaching people how to do this?" So it took her a little while, and she convinced me. Unfortunately, she passed about a year after we opened up ElliottWaveTrader. But my late wife, Becky, probably was a very, very influential person getting me started into this, and so was Harry.
It's great that your wife said, "Do what you love." It was 1978, and I was talking to a guy who was putting out one of the big financial magazines, and I wanted to use some of the previous articles that had been written back by R. and Elliott in the 30s, and so we got to know each other. And I said, I'm thinking of quitting my job and starting a newsletter. He said, "What kind of newsletter?" I said, "I want to do a newsletter analyzing markets using Elliott Waves. He says, you can't do that. I said, why not? He said, you'll never get any subscribers. He said, what you're going to have to do is you're going to have to cover the whole gamut of technical analysis and maybe throw in some fundamental analysis, or nobody's going to read you. And I just said, I just don't want to. This is what I want to do. It's what I love. And, you know, it's funny because, I mean, you have a niche, which is Elliott Wave trading. I found out, it certainly wasn't planned, that if you have a niche, people say, I already get 3 market letters, but I'm going to throw this one in. I'll get a 4th one just to see what the guys have, what he has to say. And nobody else is writing about this. And it was a great way to go. So doing what you love often comes out well in the end.
Something you mentioned, Bob, about actually going out there, and, you know, putting your call out there and being the one that actually writes it down, and just, that's something that you guys do and have done now for a very long time. And like you said, you're not always going to get them right. You're going to get some right, some wrong. You guys a lot more right than wrong, but it takes a lot to sit there and stand there and make those calls and actually then stand by them, and not, you know, when it doesn't work out, go hide the next day, right? You got to go back in the next day and adjust your accounts, or rewrite your newsletter, answer questions from members. Something that I don't think people understand, probably also the pressure that goes with that. But so you better love what you're doing.
Yeah, I've wanted to hide many times. We were looking for a new logo for our books, and my wife said, how about a giraffe? Because you stick your neck out all the time. So I said, okay. So that's what we picked.
Well,
I remember during the COVID, especially during the COVID crash, we were literally working. I was probably on the site 21 or 22 hours a day during those weeks.
Oh yeah.
And we were 24 hours a day, and I was on, I slept maybe an hour to 2 hours a day, and not often consecutively. And the amount of pressure, as you put it, was just, I thought it was more pressure dealing with that than buying into the 2009 low, as that was developing. And my wife has said this, and you know, and more than just during the COVID crash, this goes at any point in time. She knows very well when I have made a bad call, because she knows I won't sleep that night. I have a real, for me, it's more than just personal. For me, it's knowing that I potentially could cause somebody to lose money. I can't sleep that night. And my wife knows when I've made a bad call, because she knows I'm not sleeping that night. So the pressure is something.
It's a male trait. You know, a lot of men their self-esteem is tied into their level of success. So when your level of success stinks, you know, your self-esteem goes down. But one thing people don't talk about much in this business, you got to work. I mean, it's okay. So people read me every month, and I put out 10 pages, and they're like, they don't really think about, you know, what went into that. I might have one chart on a page, and it's got time relationships and Fibonacci multiple relationships or something like that. That chart might have taken a couple of weeks of work to put together. And it just, you know, you flip the page and you go, okay, that's cool. I mean, it takes a month or two to write an issue, because you're always collecting ideas, then you're putting them all together. Maybe stringing it all out at the end only takes 3-4 days, but you have to be right up to the moment that you publish. And you can't do that the moment you publish. You have to prepare all that. So yeah, there's a lot that goes into it. One time somebody said, how long did it take you to write this book? And I said, well, in one sense, it took me about 3 months. And another one sense, it took me about 30 years.
right.
Now, along with what Bob said, you know, when I'll put out a chart, even if it's a 5-minute chart, you know, the amount of calculations that will go into that to make sure that I didn't miss something. You know, I'm going through maybe 4, 5, 6 different machinations before I'll put out a chart, and, you know, I'm popping it out, but people don't realize how much work really goes into a single count, even on a 5-minute chart.
You know how you can tell, Abby? Just go all through the internet and see all the wave counts of lazy people.
Oh my God, I wail on that all the time. It does. Elliott Wave's not easy, but it takes a lot of work on the main structures, substructures to make sure everything is in alignment. It's not something as simple as people believe. And I call that wave slapping, where they just throw numbers and letters onto a chart just because the way they think it looks best, because that's what their fundamental perspective proclaims.
Right. With some rules broken and some guidelines ignored. Yeah, often happens.
Well, since we talked about some of your analysis and putting your necks out, let's go down that road a little bit and maybe start. But before we get there, let's talk a little bit about the analysis, and particularly, are there any ancillary indicators or support or other items that you like to use in conjunction with your Elliott Wave analysis? And we'll start with you, Avi.
Okay. Well, my favorite is a MACD. Normally, I like the MACD more so for finding bottoms than finding tops. Normally I'm looking for almost like a double divergence. You'll get your initial divergence in the fifth wave of the third wave, and then you'll get your second divergence at the actual top of as you're topping in the fifth wave. So I like the MACD for divergences, but I think it's even more effective at finding bottoms than it is tops. I'll sometimes use RSI, but the MACD along with the Fib pinball is really my go-to. Sometimes, you can get into a point, I've tried all these different types of indicators, and sometimes you get into a point of analysis paralysis. Sometimes they're just too much. You're doing too much. I like to keep it simple. KISS is one of my main go-to points. Keep it simple, stupid. So I'll now just mostly keep to a Fibonacci pinball structure, and I'll throw in a MACD.
Bob, what type of items do you like to, or indicators or support or studies do you like to use?
Back in the 80s, I used to use Trin a lot. And it was extremely helpful in the early October 1987 time. The market had pulled back and then it rallied for 2 weeks. And Trin got extremely overbought, and it was really, really helpful. But ever since they've gone to decimal pricing, I think it's screwed up the advances and declines. I think it's screwed up the upside downside volume. It's definitely screwed up Trin. Half these days you see the market roaring on the upside, and Trin is extremely high instead of extremely low. It's upside down, and vice versa. So I don't like that. I don't use Trin anymore. To me, one of the best trading indicators is tick. You can use it several different ways, which we won't talk about, but I would always want to have a tick reading when I'm looking at the stock market. The other thing I've been using quite a bit, especially over the past decade, are sentiment indicators. The whole point of socionomics is that social mood is behind the ups and downs of the stock market. So I want to keep tabs on social mood. The problem for me has been that some of these sentiment indicators hit insanely high levels, and the market would just keep trundling along. So I've been too bearish for much of recent years. In 2021, we had a number of, we counted something like 25 indicators, which I put all in a single report in December of 2021, which is right between the two highs that we had in November and in January, showing these indicators that had gone crazy. And I'm talking about indicators that used to be bearish when they hit 2 to 1 and they got to 80 to 1, stuff like that. It was just completely crazy. And you had to rethink everything in terms of prior benchmarks. I said, this has to be it. And I also had time things that ended in 2021. Well, so we pulled back for a year, and we got a little bit oversold, nothing extreme, and then the market went back to new highs. And here we are again with all these indicators hitting crazy levels. We just had a consumer confidence survey ask people, what their 12-month expectation for stock prices was, and they had a record number of people saying they were predicting higher stock prices for the next 12 months. So we've had so many of these indicators, and sometimes I think to myself, well, it's telling me where social mood is, but did it really do me any favors? It might have been better just to be plotting Elliott waves and not looking at any indicators at all. And Avi just kind of referred to that when he said, keep it simple. Sometimes they'll be helpful, and sometimes they can put you in a frame of mind that's unhelpful.
I'd like to ask Bob a question about that. Which are your favorites of the sentiment indicators? Because when I've looked at some through the years, I found them to be somewhat unreliable. So I really haven't found any that I'm as comfortable with. What are your favorites?
We think commitment of traders has been pretty good. There are times when they'll go with the trend for a while, but there are certain setups that you can really count on. For example, when a market starts to move strongly on the upside and the people who are generally losers, like small traders and large traders, fight the trend. It's one thing when they join, well, is that a top? But when they're fighting a trend, as they did in gold for the past year, you can just relax. I mean, you don't have to worry about it because they will get excited eventually and they will buy the trend before it's over. So that's pretty good. Again, it's not perfect. Warren Buffett likes the Wilshire 5000 to annual GDP indicator. It's not the kind of thing we normally use, but when it's at a record, we're going to show a chart of it. Back in the early 80s, GDP was 3 times the value of the Wilshire. And now the Wilshire is 2 times the value of GDP. So there's been a 6 times multiple in the benchmark. Mutual fund cash. In the old days, 4% would be a top indicator every time. It has gone lower and lower and lower. It's currently sitting at 2%. That doesn't mean the indicator doesn't work. It's telling you that the extremity of optimism and the time that the optimism has been in place has never happened in our lifetimes. There's some indicators I like as well, such as I call the speculative conservative indicator. That's the NASDAQ 100 over the Dow Jones Utilities. That was at 1-to-1 back in the 80s, okay? And now it's 23-to-1 in favor of tech. It just tells you where everybody's passion. So it's not 2-to-1, it's not 4-to-1, it's 23-to-1. So the extremity is amazing. Nobody wants a conservative stock right now. I don't care about dividends. They obviously don't care about dividends because you can get more in a T-bill than you can get from dividends in stocks. So that's another indicator I like. But all of these are very long-term. They tell you the long-term mood. What is the environment we're in? Should I be looking for a top or looking for a bottom?
Bob, apologies if you actually mentioned this, but I think you've also highlighted the junk bonds rates before. I think I've seen you talk about that, and that's actually extraordinary when it reaches extreme levels.
Yeah, and Steve Hochberg, my colleague who writes the Elliott Wave Financial Forecast, he loves that indicator, and so does Pete Kendall, who co-writes with him, because it has led stocks virtually every time. The junk bonds will start to get weakened just ahead of the stock market. That's been happening recently. Of course, it's happened a few times before, and then a few things happen, and the stock market will correct and head back up again. So none of these are perfect, but useful. I think they're useful.
So jumping right in, and Bob, I'm going to stay with you. How do you see the S&P 500 at this time?
I'm very bearish. I had a Fibonacci time sequence that began at the founding of the country and nailed virtually every major turn all the way up and predicted that 2021 would be the end of the line. I was very, very confident about that. In fact, when we topped out in late 2021 and the first couple of days of 2022, I said, that's it. Well, it wasn't it. But in a way, it was it, because ever since that time, even though the Dow Industrials are up 18% over from the end of 2021, gold is up 45%. So it's up more than twice. And that's telling me that there's so much monetary and debt inflation going on that's kind of pushing up everything, including everything from grocery prices, to the stock market. Now, the optimism is still there. That hasn't changed. But if you plot the Dow in terms of how many gold coins it can buy, it's been going down since 2018. So it's a very difficult environment. I've had to keep 4 different ways of measuring what the Dow is doing. One is, of course, the nominal Dow. And then you've got the Dow PPI and the S&P PPI. Those to me are the prettiest of all the wave structures going back 100 years. We've got the Dow versus the CRB, which is commodities, and we've got Dow Gold. And Dow Gold topped in July of 1999. In July of 1999, the Dow would buy 41 ounces of gold. And you know what the Dow will buy now? Only 15 ounces of gold. It's down 60% in real money terms. So if you had gotten out of the stock market in July 1999 and bought gold, you'd be way better off than the people who stayed with the stock market this whole time. That's, of course, if you had perfect timing, but the point is still the same. Gold has been way outperforming since 1999, 3 times as much. Stocks are up 300% from there, and gold's up 900%. So I'm very comfortable. You know, people say, well, you've been too bearish. And I say, you're right, I have. However, I also, in the latest version of Conquer the Crash, which I call Last Chance to Conquer the Crash, came out in January of 2022. And I said, what you want is you want gold and you want to store it offshore. And I showed them where to do that. I said, silver is the cheapest commodity in the world relative to what prices were back in 1980, which is, 40 years ago. That looks attractive to me. T-bills are good. I'd roll them over all the time. This was back when rates were just coming off 0. And I said, these are going to go up. They're going to keep going up. So they went all the way up to 5.5%. And you were able to lock in with an overseas bank that I recommended, which is extremely safe. You could have gotten a CD last January at 5%. And you're still making 5% if you have a 1-year CD. So I think we're doing good turns to people. You could be wrong on some markets, but right enough on others that it's like, you know what? I don't want to play that game. We're going to play this game. And I'm not that unhappy with the way we're sitting right now. I'd rather be safe, what I call safe, than exposed right now, even if I've been right for a while, because I think they could pull the rug out from this market anytime.
Thank you very much. And Avi, same question to you. How do you see the S&P 500 at this time?
Well, I'm pretty much pretty in much Bob's camp at this point. Personally, I've taken out about 50% of my positioning already and put it into cash and treasuries, mostly treasuries right now. But I will say that I am considering taking back about half of that and putting it into the market for maybe a 6%, 7% return, because we could be developing, because I'm more focused on a little bit smaller degree than Bob. I'm seeing the potential that we could be developing a rally that could push us up towards 62, 6,300 before this whole thing comes apart. So if I get the setup I'm looking for in the coming week or two, then I may take that money and just put it back in for another 6, 7%. But overall, I'm of the same perspective. We're talking about, 100-year rally off the almost 100-year rally. It's now 92-year rally since we hit the bottom of the 29 market crash. So and we're about to hit 93 years. So yeah, I'm of the opinion that we're coming very, very close to a major top. And what I'm guesstimating is that it could lead to a minimum of a 13-year bear market, potentially as long as maybe a Fibonacci 21-year bear market. And I'm surmising that the fourth wave of one lesser degree, and I'm looking at it as a large degree fourth wave though, but the fourth wave of one lesser degree, in my opinion, was the 2000 to 2009 sideways market. And if that was a 9-year correction, I think it's a reasonable assumption that a correction of a greater degree is going to be of greater time than that. So I'm pretty much in Bob's camp, and I'm looking for a very long-term bear market.
we're talking about primarily the S&P 500 here, but are there other markets that you track? And are they right now in alignment with what you're seeing? Are there any that maybe give you some pause, or you're looking to see more data, maybe something like a broader index, like Bob mentioned the Wilshire earlier, or the Russell 2000? Obviously different markets, but are you seeing similar things set up there, or different?
Is this to me or Bob?
Yeah, I'm going to stay with you, Avi, and then
Okay. I have my eye on the ETF EEM, emerging markets. And I know Garrett tracks the individual charts as well, but I have my eye on the emerging markets for potential for some of those charts to outperform the S&P 500 during corrective B wave rallies in the S&P 500. So I'm watching that very carefully to see if those type of setups develop where we could actually move into some emerging market plays to outperform the S&P 500, but that's only during B wave corrective rallies in the S&P 500 once we move into the bear market. But for now, I'm still seeing potential for the next 12 months, 18 months or so in the metals charts. So I still think there's more room for gold and silver to be heading higher. Right now, my general expectation is for gold to get up to around 3,400, but I'm still expecting what could be as long as a 6-month fourth wave pullback in gold into 2025, but still seeing one more rally that potentially could put us up into 2026 for that. But after that, I'm seeing a major bear market in that as well, potentially taking us back to 1,000 or 1,200, 1,300 back in gold as well. So, I mean, outside chance of 300, but I think we're way too far to even consider that at this point. Right now, for the longer term, I'm looking at about 1,000, going back to 1,000 to 1,300 in gold once we complete this rally. But I still see some potential in gold and silver and mining stocks as well over the coming 12 to 18 months. But clearly with some sizable pullbacks as well.
Yeah. So Bob, then turning to you, are there other indices that you also track, like NASDAQ, Russell, or others? And if so, are they lining up with what you're seeing in the S&P? Is there anything about them that's giving you some pause? And certainly too, actually the next place we were going to go was to more expanded into gold. So if you want to hop right on there too, that'd be great.
No, it's a good question. Sure, we track all the indexes. I mean, the Russell 2000 topped in 2021. I don't think it's going to go to a new high. The Dow Jones Transports topped in 2021. I don't think they're going to a new high. The S&P is the most overowned thing in the entire world. The Swiss Central Bank has a huge position in all the high cap stocks in the S&P 500. It's the basis of their currency, is what the Swiss bank holds. I mean, when this thing unravels, it's going to be epic. It's going to be unbelievable. Now, as far as gold and silver, there's some benchmarks there. Of course, we're tracking the waves down to a very small degree. We think we're getting very near the top of an internal third wave. We don't think it's over yet, but we're ready for a correction here. However, I don't think gold and silver are going to top until the gold-silver ratio plunges. In 1980, silver was tracking with gold, kind of going up. And then when silver went crazy and went all up to $50 an ounce, the gold-silver ratio collapsed. So what happens is people are becoming speculative. The last thing they do in the precious metals area is they buy silver. And there's a mania for silver. And the same thing happened in 2011. Silver got really hot near the end of that move until that ratio plunged. Well, the ratio has been hanging around 80 recently and has not plunged. Silver has been lagging. I think it's going to take silver to catch fire before the precious metals rally is over. So I think, we'll have corrections along the way. And I think each time we have one, people say, that's it. Too many people are interested in gold. When in fact, gold is, if you look at money managers, for example, is the incredibly underowned. Gold and commodities are both really underowned. You could go back, say, the late 60s, early 70s, and you'll find that money managers actually had gold under management, and they hardly have any anymore. So if they ever decide that they need to buy some gold for their customers, I have no idea where it could go. It's not cheap anymore, though. definitely not. I think it's in the phase where it's in a speculative phase, and we'll see how high it can go. But you know, we got excited about gold back around $1,850, and it's up about 50% since then. Silver's not up as much, but I think it's going to catch fire. And when it does, you know, hold your breath for a few weeks or a couple of months and then get out, because when silver turns, it's really dramatic. Got to be careful there. That's about it. I'm mostly in a be safe mode. I think there's a chance that interest rates will have a panic period sometime in the next 5 years, where everybody in the world is going to be having to pay double-digit interest to borrow money. And I don't think it's going to be because of inflation, although it's possible, because inflation's managed to continue so far. But it could just be because of deflation and worry about defaults. We have so many zombie companies out there. These are companies that can't even pay the debt that they owe, so they put out more debt so they can pay the interest that they owe people. It's amazing to me that anybody is lending these companies any money at all, but they're still operating. It could take probably 6 months, maybe even less, of somebody worrying that this company isn't going to be able to borrow any more money, and the game is up for so many companies. And you've got these venture capital firms that have put billions of dollars into buying up companies because they wanted to run them? No, because they wanted to sell them to some other greater fool at a higher price. Well, right now they are stuck with more inventory than they have ever had, hoping for a chance to get out. If Avi gets his rally, they're going to get a chance, and maybe they'll get out. But or if they hold through that rally, or if there is no rally, they will do what Wall Streeters have done time immemorial. They'll finally sell out at the bottom sometime in the future. So we'll see. You know, Bitcoin is another one that a lot of people are interested in. And my son Elliott wrote a piece for me back in 2010 on Bitcoin. It was trading at 6 cents at the time. We put out 2 pages explaining what it was and why it had such huge potential. And when it got to about 6,000, we thought it was crazy. Well, it went to 70,000. Well, is that stupid? I don't think so, because, okay, it went up 10 times from 6,000 to 60 plus, but from 6 cents to 6,000, that's 600 times. So people might think, oh, it's gone up a lot, but in percentage terms, the big move was early. I love to be early on stuff when people are not looking at it. When everybody and his brother is involved, and they're all arguing about whether it's going to continue for how much longer, you can tell it's a mania. And I think we're in a stock mania. I don't know if it's over yet, but as I've said a couple times, the toys are in the yard. You can play with them if you want. I'm staying in the house.
Now, something like Bitcoin.
I'd like to add something to what Bob said about silver, and I could not be in more agreement about that. It's gotten to the point in our chat room where I've actually modified my silver chart to identify where people are bitching about silver. And when I've actually identified the last several small degree bottoms were maximum bitching. And the truth is, silver is setting up in a similar way that it was in 2010. And if you look at the 2010 chart, the 2010 chart was basically straight up once silver hit its stride. It just went straight up. Yeah. And, once we got into 2011, it started slowing down before it hit that top. But yeah, and it also hit its top before gold, about five months before gold hit its top.
Yeah.
But silver still has not hit its stride. And I am literally begging people to not get frustrated about silver as much as they are. Yeah, it's lagging, but you know what? It's still up over 30% this year, but it's lagging. And you know what? You'll wake up one morning and then you're going to have a month, 2 month long, 3 month long parabolic rally. And then you'll thank me for being long. And
no, they won't.
What I say.
No, what they'll do is they'll tell you, what do you mean get out now? This thing is going to the moon. Are you crazy? Yep. And then you'll be fighting that as well. Yeah, it never ends. It never ends. Human psychology what pushes markets up and down, and you can't change it.
I remember when I wrote an article back in 2011. I wrote the article in August of 2011. And I said, you know what? I'm taking a very long-term chart of gold, and it's pointing me to, I think the number was 1916. And I said, this is a top of a fifth wave. And I think, you know, if you get to 1916, even if you get over 1900, I think you sell. And, you know, people at the time were arguing, all the analysts were arguing, but what were they arguing about? How much past 2000 are we going?
Oh, yeah.
That was the argument. And I think we hit the top was 1921, was in $5 within that long-term target. And Bob, I completely agree with you. We're going to have the same problem once we hit these tops in the metals again.
Well, Abby, that was a great call. I can recall 2011 very well because I was I was invited to participate in sort of a panel-like thing about the metals. And I think it was the summer of that year. And silver was really starting to move, and it was up around $35, and everybody was, you know, predicting 100 or 200. And I said, look, you've got to start scaling out here. And they jumped all over me. Now, it did go another $10 or maybe even 10 to 14 more, I think. But I couldn't say this is top tick. I said, but look, this is a fifth wave, and you're now into the blow-off thing. And I said, do you remember what happened to oil in 2008? You know, the fifth wave was straight up. I had a target in that as well, and it missed it, I think, by $20. But I said, this is the fifth, and it's the fifth of the fifth. And when it spiked, oh my God, it was unbelievable the way it crashed. And I said, you know, silver's heading into that kind of top. One financial gold bug got so mad at me that he called somebody who did a podcast, and he said, if you ever have that Prechter guy back on, I'm going to quit. He said, you have to ban him from talking about the metals anymore. That's the kind of psychology you fight when you get into a top.
I remember I had one of our money manager clients tell me a story that when I was calling for silver to go back down to $20 or lower, and this was when silver was still in the mid 40s, and he stood up at a conference that he was at, and they were in the middle, and you know, they were asking questions, and when he brought this up that, you know, he has an analyst that, and he mentioned who I was, that you know, is calling for silver to drop down to 20 and lower, they basically laughed him to sit down. They basically laughed at him so much so that he was so embarrassed he had to sit down.
Yeah. The first speech I ever made was for Jim Blanchard's NCMR group. And of course, that was a gold bug group. And I still speak for them. I love the place. But it was the summer of 1980. And I said, I think gold has topped, and this rally back is not going to a new high. And if you recall, in the summer of 1980, gold stocks were making new highs. And I said, this doesn't have much longer to go. It's a B wave, and we've got, you know, A, B, and 1, 2, 3, and we're going to have a 4, 5. It's going to be over quite soon. There were 999 people, I remember, in the audience. This was in Montreal. And I saw 999 heads go. You know, and I was just a young kid, you know, I was, I guess, 31 at the time. And, you know, it was my first big speech. So I was a little uncomfortable, but, you know, you got to say what you think. And unfortunately, many times I've said what I thought. It didn't turn out to be right, but I do like remembering those contrary opinion times. I tell you one thing, I don't think Avi or I is afraid of being contrary. Sometimes it doesn't make us right. But we don't herd. We don't join the herd.
I remember another time during the COVID crash, as we were coming to the bottom of it, there was another fundamental analyst who wrote for Seeking Alpha at the time. And I put an article out on Seeking Alpha that said, you know, 2,200, I'm buying, and I'm buying big. And, you know, my expectation was we were going to go over 4,000 from there. Because I saw that as a fourth wave, and I saw my fifth wave projections were minimally at 4,000. The ideal target at the time I had was 5,350 to 6,000. So, you know, I said 4,000 should be a no-brainer. So I was literally torn apart in the comment section, because at the time we were crashing into those lows. And I used this other Seeking Alpha analyst posted a 2-paragraph or 3-paragraph comment in my article saying to me that, the stock market is broken. The economy is going to pull the market down. There's no way to believe what Avi is going to believe, that 2,200 is going to hold and we're going to magically make it up to 4,000. Either you believe Avi's chart magic or you believe the real world. And I use that comment quite often in my articles today. It's just so typical.
Yeah. Well, that was a great call. I mean, there are times when I've had to fight, in that kind of environment, and other times when I fight and then I have to, put my tail between my legs a few months later because I'm wrong. So it does happen.
Happens to all of us. Happens to all of us.
On balance, I think we do a pretty good job for people. Every now and then we get somebody calling in and he'll say, well, your intraday guy and your intermediate guy are saying different things. You can't have this. How could this possibly be? And I have to write them back. I said, look, each of these guys are really good. I said, now think about it. Suppose one of them is right 70% of the time and the other one is right 70% of the time. Do you know that they could disagree 60% of the time? And you would still end up doing very well with either one. But you're going to have times when they disagree. That's okay. I mean, this is a game of probability.
We struggled initially when we started hiring analysts. And the question, of course, came up, well, do we have a house count? I was asked that, and do we have a house count? And my answer is, well, let me ask you a question. I'm hiring somebody because I think they are a fabulous analyst. I love their work. So does it make sense that I love somebody's work enough to hire them as an analyst and then turn to them and say, okay, shut down now, you're going to follow me? Absolutely not. Because
No.
and I'm going to see, and they're going to see things that I'm not seeing, and it may even enlighten me. And that's why I never, ever, ever tell any of my analysts, you know what, you have to follow me. I want to know what you think. I hired you because you're so good. So I'm in complete agreement with you there.
Do you find that creates that ability for the analysts to challenge each other in that kind of professional environment, then leads your sites to get to the best overall analysis?
No, I think they're individuals. I don't think they care much what their colleagues are thinking. I mean, really, they're doing their own work. And if they have to change their minds, we all do eventually.
So
If the market
they've
forces
got,
you've got to adjust,
they've gotten comfortable being on the other side, just like you guys. So they don't mind who else is doing.
No, I just think it's their egomaniacs. I mean, I'm partially joking, but they're confident in what they think. And whenever you're not confident, you might call one of your buddies and, hey, what do you think's going on here? I'm lost. But, if you have an opinion, it's your opinion, and that's good. That's how you get tested. That's the battle. That's, if you don't fight the battle now and then, how are you going to be good in the next one? So it's good.
There are times where, if I'm questioning my own analysis, I will get on the phone with our other equity analysts and we'll just spitball. What is everybody seeing? What makes the most sense? I'm wondering, did I miss something? So, well, Bob said, yeah, you have to be confident in what you do because you have to recognize, you're a good analyst and you put out good work. So you have to be confident in what you're doing, but you also have to recognize, and I say this all the time, I'm not God. I'm not a prophet. I'm a simple analyst and I'm going to be wrong. It's just the nature of the game. I'm a fallible human being. I'm going to be wrong. But the question really comes down to, well, I know I'm going to be wrong. I better know how to recognize that I'm going to be wrong early enough so that I can stop any bleeding. That is really what I like to focus on. And that is, I know I'm going to be wrong. I'm going to tell people this happens, I'm wrong. and it's time to change to the alternative count. Some
You know,
people out there make fun about alternative counts, but I say, it's like a general going into battle, and he has his main battle plan and he has a contingency plan. You need that contingency plan. It saves lives. Same thing with the market. You need that contingency plan, and you need to know when to activate it.
yeah, for sure.
So since you both are looking for a larger degree bear market to begin, what are some of the major impacts you see this having upon the public? And Bob, I think we'll stay here with you and have you like that. So, so what are some of the major impacts you see this upcoming bear market having on the public?
Absolutely massive. We got the highest public participation in the stock market ever by multiples. Huge amounts, and many people are in the market and don't even realize it. They've got some shares in their company pension plan, or they've got that are deeply involved in the markets, or they've all kinds of ways. And many people recently, the amount of stock exposure to the stock market among households in the United States hit a record level. Now, why is that amazing? Because house prices are also at record levels. So that means they're gorging on stock to an even greater extent than their house prices have gone up. Their house value has gone up. So the embracing of stocks is unbelievable. Okay, now that's mom and pop. Now you've got the money managers. They're down to 2% cash. That means they don't even think there's a chance of a correction of 10%, because if they might want to lighten up and have some cash and buy it. It's just, they're saying, we don't think the market could go down even enough to make it worth raising a couple of percent more cash. So those are the money managers. And then, as I said earlier, you've got some central banks that own S&P shares. They've got NVIDIA, and they've got, Google and all this sort of stuff. And I'm just thinking this is some sort of mass insanity. But of course, again, it's just an expression, in this case, globally, I think, of extremely positive social mood. Now, many people say, how can you say social mood is positive? Politics are so divisive right now and everybody seems angry. I said, well, you remember 1968? I mean, the value line index was going to new all-time highs in 1968 when you had the Democratic National Convention and all that, unrest and stuff. That can happen, but the financial mood is the most positive it's ever been. And one of the things you mentioned, Tom, a little while ago is what junk bonds are doing. And the spread between junk bond yields and treasuries got down to one of its lowest points ever a few months ago. And we were just amazed that anybody would jump into zombie companies and buy this junk debt. So they're doing it because they are utterly complacent. They have not a worry in the world. And, the difference, Avi earlier mentioned what happened in 1929, 32, 33. Well, people went from, dancing in short skirts to standing in line for bread in just a very few years. So things can turn when they're this extreme, and everybody is so invested in the financial system, maintaining with all this debt and leverage on debt and debts on the leveraged instruments. If it implodes, it's going to have a lasting effect. They said after 1932, many people never touched a share of stock again. They didn't even trust the banks. They kept their money in mattresses, The last time we had a grand super cycle bear market was 1720 to 1784 in England. That was 64 years. I think that was a zigzag, by the way. By alternation, we'll probably get a triangle or a flat. I'm pretty sure it's going to be a triangle. That means the first wave down is going to be the most severe, assuming it's a contracting triangle. But I think the whole bear market should last 100 years. I think we're going to go several generations. We're still going to have the massive B wave and D wave. I mean, there'll be bull markets, but I don't think it'll reach anything like we have today for several generations. That's how crazy it is.
Avi, same question to you.
Well, my biggest concern actually centers around the banking industry. Whereas there's a certain amount of the public that does invest in stocks. It generally is not the largest percentage of the public, and a number of years ago, I was just looking at the banking stocks, and they just look like crap. So, I was wondering what is going on with the banks. So we actually brought on a fundamental analyst, a banking analyst, to look under the hood at the balance sheets. And he and I started looking at the balance sheets of all the larger banks, and it scared us what we saw. In 2007, there was one major issue that took down the banking sector. Right now, there are 4 or 5 major issues that are sitting on bank balance sheets. And there are generally 5,000 banks throughout the United States. It took us a year and a half of research just to come up with what we thought was the top 15. A year and a half, because each bank we looked at, we had to throw it out because we couldn't even get into it because the red flags just came up right away. And a significant number of banks throughout this country have red flags. There's a very small percentage that don't have red flags. And the ones that you can go into that don't have those red flags, that don't have the top 4 or 5 issues, you then delve into those to find, okay, what has the most solid balance sheet out of those? And I'll tell you, this is going to shock people. We cannot find a single bank in the state of California that not only would be considered a solid bank, we can't find any banks that have branches in California that have a solid bank that we would actually suggest to clients. That's how bad it is. Yeah. So my concern is what's going to happen to mom and pop, the general public, when this thing goes under and the banks start really taking on water. It's going to make 2008 look like child's play. And that's my biggest concern about what it's going to do to society as a whole, because people don't understand the relationship they have with their banks. They're going to think they have this money in their banks, and then you're going to have a Cyprus event where you're going to have a bail-in forced upon them, and they're not going to know what's happening. And I think it's going to tear society apart at that point.
Yes, and the FDIC hasn't got a fraction of the money it's going to take to save all these things.
In 2008, the FDIC went negative. Their DIP fund, the deposit insurance fund, went negative by something like 20 or 30 billion. And that was after a very short period of time of a banking crisis. Imagine a long, protracted crisis.
Right. And many people don't realize what the FDIC does. They charge the healthy banks to bail out the crappy banks.
Yep.
And so if they have to charge them more and more money, it means the bad banks are going to be sucking the life out of the good banks. It is the worst imaginable setup. So even you can't even find an independent bank that is outside the system. It's extremely difficult. That's one reason I recommended and Conquer the Crash. I looked very hard and I found an offshore bank. It's actually in the Cayman, so it's nearby. You can get there if you want to go there personally. It has one of the highest liquidity ratios of any bank in the world, and I don't know if it'll maintain, of course. I can't guarantee a thing, but that's what I'm after. I don't want a bank that's lent out to the teeth. And so many of these banks, I know that one of your red flags has got to be commercial real estate.
Oh, easily. Yeah.
Loaded up with commercial real estate, and they probably had meetings and said, what are we worrying about? We've got collateral. Good luck with that.
Oh, talk about collateral. Most of the collateral they have are in treasuries, but those treasuries are underwater.
Yeah. I think most of the collateral is going to be collateral damage.
Yeah. Yeah, I agree.
Well, now that you've scared all of us,
it is a little scary. Let me just interrupt though.
No,
the whole goal here is to get people in a position where they won't have to be scared. When we had the meltdown in 2020, and even when we had in 2008, I would hear from some people who said, you know what I'm doing today? And I said, no. And I'm going to go fishing. I'm relaxed. So anyway, one of these days it's going to come to the point where even the people who tried to stay safe are going to wonder if they're safe. I think it's going to be that huge, but we'll see. I mean, so far the government and the Fed have managed to reinflate the system. I don't think they can do it forever, but we shall see.
I like giving the example of the Great Depression. During the Great Depression, I think it was about 35 to 40% of banks went under. So a significant number of banks. But when you consider the other side of that coin, it means that 60% of the banks still came through.
Yeah.
So, are we going to have 60% of the banks coming through? Are we going to have 50% of the banks coming through? I don't know. All I do know is if I'm going to have a United States bank for purposes of what I need in the country, then I want to make sure I'm finding the safest banks I can, because
And
I'm going to give myself the best shot to be able to get through that.
Yeah, Avi, I know you know this, but the listeners might not know this. In Conquer the Crash, I recently replaced the pages where I said to go for recommendations on the safest bank in the United States, and it's the service that you're offering.
Thank
So
you, Bob.
I recommended people go to you to find out which those banks are. I think it's crucial, and I've also said this in Conquer the Crash years ago. It's still there. The safer banks, once people realize that safety is actually a value in the banking system and start seeking out the safer banks, the safe banks will get even safer because they're going to get more deposits.
It's funny, people will say to me, well, the bank that you sent me to is not paying me much in interest. And my answer to them is, well, of course not. They don't need your money. The ones that are going to be paying the interest are the ones that need your money. And then I go back to Goldman Sachs, and I wrote this article back in 2016 when Goldman Sachs did it. Goldman Sachs, for the first time in their history, opened their bank to public deposits. Now, why would they open it up to public deposits? Because they're being so generous? No, because they also see what happened in Cyprus. They see it's going to come here, and they want to have an opportunity to have their own bank bailed in from all these public deposits. So, this is going to be a big mess. And, most people really are not, I'll write a banking article, and it's barely read relative to an equity or a gold article, barely read. And it's because people don't care. People think banks are safe. They think the Fed is going to bail it out, just like 2008 and 2009. And all the Fed did was create a Pavlov's reaction. And unfortunately, they're going to have this Pavlov's reaction. And, they're going to assume, oh, we're going to go down. Great. The Fed's going to handle it. Fed's not going to be able to handle it. This is the first time in the Fed's history that it has been losing money on its own. The Fed has been losing money. So no, the Fed's not going to be able to handle it.
Yeah, and there's another aspect to this, which I've tried to explain in my book as well. When panic hits, you can't think straight. When 9/11 happened and people were running around like crazy, or when even the crash of March 1980, people were in absolute panic, and you can't think very well in a state of panic. You have to act when times are calm. And that's why I said, look, now's a great time to go open an account at this bank that I found. You don't have to put any money in it, but at least it takes a few weeks really to get the dang account open, because they have all their rules as well. They have a treaty with the United States that means they've got to have to follow certain rules, and they do. And they're very conscientious, and they're going to want a lot of information, and you're going to want, have to go get certain documents and things like that. It takes a while. If you want a second passport, this could take 6 to 8 months. If you want to store some gold offshore, that's a little faster, but it still takes a little bit of time. And who knows how efficient they will be if everybody else is in a panic. And they got 65 phone calls ringing off the hook if some people want to buy gold and store it there, and they won't be able to handle the business. If you're already there, you're fine. So it doesn't mean you can't speculate. For example, let's suppose you get 90% of your assets in the safe banks on your list, and the safe bank that I've got offshore, and gold storage offshore and stuff like that. So you're feeling, okay, I'm safe. I got a second passport if everything I have to leave. We're in good shape. All right, fine. Take 10% of your money. And if you're bullish on stocks, buy some futures. If you're bullish on gold and you want to speculate more than what you've got in hard money terms, buy some futures. That's okay. You're bearish, maybe you want to, sell some futures or buy some puts or something like that. That's all fine. You can still play, but you've got your bunkers all built and your money's in it. And The time to do it is when you're not worried and you can calmly think about it and get your spouse to help you with the paperwork and all that sort of stuff. It's important to be early.
And along the lines with what Bob said, we have to remember those that have been trading, have to remember, for example, the flash crash of 2010, what happened during the COVID crash recently. Markets seize up, and you may be on the correct side of a short trade. Doesn't mean you're going to be able to cash out. So, does it make sense to take, mortgage your house, even though you've got a great setup for a massive decline, and mortgage your house and put it in? No, it doesn't make sense. You have to be much more judicious during a major bear market, because markets will seize up and you may not get your cash out, even though you're on the right side of the market. And we learned that. I mean, anybody that traded during that one day of the flash crash knew that. Anybody that traded in 2008, 2009 wasn't as bad, but it was bad. But then, during the COVID crash, we had many brokerage houses seizing up at certain points throughout that crash. So you can be on the right side, but not necessarily make the money you think you're going to make.
That's right.
Do you believe that the Fed and central banking, as we currently know it, will survive this period, this bear market period that we could be entering into? And
Am I going first?
Why don't you go first,
Okay.
Avi? Jump in.
Okay. If you look at one of my charts, one of my long-term charts I put out a while ago, a very large A wave down, the first major A wave down, I put in Fed buys everything at the bottom of it. And then we have this B wave rally, and then we have the C wave crash. And then at the bottom of the C wave crash, I put Fed fails. So do I think that we run the risk of the public calling for the end of the Fed because they feel it's been ineffective? Certainly, I think that is certainly within a possibility. So
They did it in Argentina. They got rid of their own central bank last year or earlier this year.
Wow, I didn't realize that.
Yeah, Javier Milei took over. He's a libertarian, and he said, we're going to do this, we're going to do that, and I'm getting rid of the central bank, and he did. Now I don't think he made a particularly wise decision, because he said we're going to peg our currency to the dollar, but it's better it is better than their own central bank, which had them going at 1,000% annual inflation rate. So yeah, it's possible for people to get fed up and say, let's get rid of our central bank. In fact,
Now,
the United States did it once in the 1800s. They had a central bank and they dissolved it.
does that make
Hamilton probably wasn't too pleased with that.
No.
Does that make either of you nervous about what then takes its place? I mean, we're going down a lot of roads here, but we're still left with the same group of people that then have to figure it out together.
No, that's a great question, because an absolute nightmare would be digital currencies that the government controlled. That would just be a total disaster. If somebody like Javier Milei took over, maybe they'd say, we're going to go back to what the Constitution says, which is no state shall use anything but gold and silver as legal tender, So it would be nice if they stuck with the Constitution, but they didn't. So theoretically, they could go back to it. But I suppose, being a student of history and seeing what happened to, civilizations in the past, all the big civilizations, it's really tough to say, oh, we're going to be different, we're going to go back to first principles, because none of them ever did. They went all the way down the wrong road until they dissolved. So, maybe it's just old age that makes me a little pessimistic about that, but history doesn't have many examples of people voting to improve themselves. Although maybe Argentina just proved us wrong. We'll see.
I'm pretty much of the same opinion as Bob, and I look at it, and I say this all the time. I'm a simple analyst. I'm not a prophet. There's a limit to what I can foresee, and I definitely cannot foresee that far.
Yeah, miracles happen. Political miracles sometimes happen. So you never know. That could be. Markets ought to be ahead of them, though, right?
Yeah.
So I know some of this you've already mentioned, but I do want to kind of encapsulate it here because I know we've already gotten some questions from people at various stages in their life saying, well, wait a minute, what do I do? Where do we see that people could possibly park their money or look to invest during this period, whether that be specific areas or just even general guidelines of what they should be doing? And Bob, let's have you take that one first.
I think we've covered that, all the markets and the places, and even Avi mentioned, a good chunk of T-bills right now. Now, I happen to like FRNs, floating rate notes, because they're 2-year periods, but they fluctuate to the T-bill rate. So wherever the short rate is, that's the rate you're earning, but you don't have to roll them over every 30 days or 90 days. It's auto correlated for the 2-year period. So you only have to think about it every 2 years. Those are very handy. And a CD in a super safe bank, such as I think I've recognized is a good idea. I think if people want to prepare, they should do a couple things. They should probably check out Avi's list of safe banks. I think they should get a copy of Conquer the Crash. And I've covered everything in there, and all the things that I mentioned about these places where you can, find safe things offshore are in there. How to get a second passport, all that stuff is in there. Just go to ElliottWave.com/books. Anybody who's watching this, who's maybe interested in seeing what we have to say and how we frame our market analysis, can get a whole month of all of our services for $11. Just go to ElliottWave.com/11. We set that up specially for this, money show presentation. It's only going to be up there a few weeks, but it's the kind of deal we don't offer very, very often. Start, maybe hook up with, the people that in Avi's group that are teaching you, if you care to be a trader or an investor. You can learn things that way. So self-education is the way to go. The crowd will always be wrong eventually, but an individual can do something different from the crowd. If you're an individual, start learning about these things, make up your own mind. I mean, we're there to provide some help, but ultimately, you're going to have to make up your mind about what to do. But it's better to be informed, and those are some of the ways you can get informed. And you know what? You're not going to find them on any other websites. You're not going to find, lists of the safest banks. You're not going to find these offshore opportunities anywhere else. You can go on some of the biggest websites on finance, and they'll be talking about things that Avi and I really don't care about. What's the Fed going to do at the next meeting? Here's a classic example. I'm going to get on a tangent for a second here. People say, oh, when the Fed finally lowers its funds rate, it's going to mean this and it's going to mean that and so forth. Do you know that the bond market, the interest rate on 30-year bonds bottomed the day before the Fed lowered its federal funds rate? It's been going up ever since. So, I mean, talk about, buy the rumor, sell the news. You want to sell the news in situations like that. If you're an informed person who has read, I think it's chapter 3 in my book, or maybe chapter 4 of the Socioeconomic Theory of Finance, you'll find that the Fed is not ahead of rates. They simply follow the T-bill rate. They claim to be doing all this analysis about, on the unemployment rate, and they worry about this and that. They're not. They follow the Treasury bill rate with an average 5-month lag, and they did it again this time. And we said they're going to lower the rate a lot. And they did a 0.5 point. They could have gone 3/4. If rates don't change from where they are right now, they will definitely lower it at the next meeting as well. So I can predict the Fed's federal funds rate all day long, all year long. Just watch the T-bill rate, and you can do it too. So again, get informed, learn what's really going on behind the scenes, and that'll change your life.
Along the point of what Bob said, I just pulled up a quote from Alan Greenspan himself about the Fed. And this is an actual quote of Alan Greenspan. We really can't forecast all that well, and yet we pretend we can, but we really can't. That should say it all.
I'll just interject one thing, and then
yeah.
He had another great quote, which I think I quoted in STF, Socioeconomic Theory of Finance. He got frustrated because people were yelling at him for keeping their interest rate at 0 for so long, and he said, "We didn't do that; the market did." It's the first time a Fed governor has ever spilled the beans and admitted that they just follow the market. It was awesome.
It's true. But along the lines of what Bob said, Conquer the Crash was a book I first read many, many moons ago. And Bob covers so many aspects of what you have to be looking at during that type of environment that I think the book is invaluable. Once we move into this bear market, you really have to understand all the points he makes in that book. I think that book is invaluable once we're moving into this bear market. I think a safe bank, I shouldn't say that a safe bank. I think multiple safe banks are what you really are going to need. And you're going to want to diversify your cash into various banks. When it comes to treasuries, right now, I would not be holding anything long-term. I would not hold anything beyond a year or two when it comes to treasuries. The way the bond market seems to be setting up for me right now, I'm thinking that the second half of this decade is probably going to give us a major bond market crash. So I think we've started a large B wave rally that will wind up being transformed into a C wave crash as we look out into the second half of this decade. So ultimately, I'm not a fan of holding anything long term in treasuries. You want to hold something short term, that's great. Treasuries even have certificate of indebtedness, I believe, but they pay no interest. It's just for the treasury to hold it for you. I don't see a point in that, because my fear is the rates are going to be rising because people are going to lose trust in the government's ability to pay their debts on time. And when that happens, we run the potential, and I know nobody will believe this is even possible. But when you look at where our general debt is, and where you look at what the federal government can afford now, we're probably going to get to a point in time where the government can't afford to pay the interest on its debt. And when that happens, you're looking at debt getting cut. You're going to look at getting haircuts on debt. So, there are going to be times where I'm not even going to want to even touch treasuries. So, that's why I think cash is a lot safer than most people believe. People now believe cash is trash, but I'm not of that same I'm not of that same group. I'm a big believer in holding cash, because when everything deflates and all assets come down in a big way, your cash becomes that much more valuable. You just need to find a safe place to hold it so that you can use that cash. And I think Bob hits on that in Conquer the Crash quite often. I think it's a point he makes quite often in Conquer the Crash. So I think cash is going to be important as well.
Yeah, you mentioned the Cyprus thing. People that actually had paper cash were fine.
Mm-hmm.
But if they had a bank account, they weren't.
Yep.
I know we've gone a little bit over, and I don't think anybody's minded. I sure haven't. But there is one question that came up a lot, and I think we can get to it somewhat quickly here. It's a hot button topic, or it's a popular topic that you hear, and it's artificial intelligence. And so people are asking, do you think AI will be able to effectively apply Elliott Wave onto charts? And
Who's
Avi
taking
will
that one
start.
first?
Avi, will start with you.
I am not as big a believer in AI as most are right now. I think there is a human factor that it comes to people have said, Elliott Wave is great. There's a lot of subjectivity to it, and a lot of people believe that it's more of an art than a science. I believe there's some truth to that, and that's why I think that AI will not be able to conquer Elliott Wave. We may be able to conquer the crash, but I'm not so sure AI will be able to conquer Elliott Wave. That's just my opinion as I'm seeing it right now. Maybe down the road it'll change my mind. We may see something, but I just believe that when emotion is involved, I'm not so sure that anything will be able to conquer emotion when you're dealing with the masses.
Okay. I do have some thoughts about this. I think the wave principle is objective, but it's so complex to know every aspect of every wave that has ever happened, and therefore draw from that knowledge, that you can't do it. Human brain doesn't have the capacity. So when you're doing analysis, the fact that there are alternate possibilities, the fact that virtually every count has something else that it could turn into, brings you into the area of uncertainty. And one of the biggest points I try to make in the socioeconomic theory of finance is it's uncertainty that separates financial markets from economic markets. When you go into a store and you look at a can of sardines, it's going to cost you whatever, $2, $3, whatever. And you know, when you go in next week, it's going to be about the same price. When you're in a financial market, you have no clue what the price is going to be next week. Anything, it could be anything. And that uncertainty leads people to stop thinking rationally and to begin thinking non-rationally. It makes them herd and it makes everything go crazy. So even Elliott Wave analysts can't escape that, because as soon as the uncertainty begins to come in, you begin to, at a very subliminal level, I would call it an unconscious level, begin to worry. And when that happens, it fires up your amygdala and it wants to hurt all the time. And it wants to push you into actions and you have to fight those. So you get into a very difficult situation. Now, way back in 1986, I got contacted by a guy who worked at Lockheed Corporation. He said, I think we can computerize Elliott Waves. And I said, yeah, I've been wanting to do that for a long time. I had even wrote a little piece about that in I think it was 1981 or 2 that I never published. And so I hired him and his colleague, and they worked for years to computerize the wave principle. Well, he did a very good job considering, but back in those days, computers couldn't handle everything they had to handle. They weren't powerful enough. And he frankly didn't quite have everything down properly. Well, in 86, when I started this thing, my son was 2 years old. Eventually he grew up, he went to MIT, he became a computer specialist, got a degree in computer science. He went to work for Microsoft, then he went to work for a hedge fund. Long story short, I was talking with him and I said, this whole trip that you've taken in your career, I've got the perfect project for you. I said, we need to start from scratch and redo our Elliott Wave computer analysis program. So he looked at it and he said, I think I might be able to do that. Well, it took almost 10 years, but he finally finished it last year. And so it is amazing. If we had a minute to share screen, I'd show you a recent count it did on gold, and it's unbelievable. It looks at every degree of trend all at the same time, lightning fast, with no uncertainty. It has no emotions. It has no, unconscious. There's no consciousness to be unconscious about. So I think we've objectified it to the extent possible. And an interesting aspect of this program is there's no quant analysis in it, not an iota of quant analysis. Every single item in there is relative. It's what is the length of this wave relative to that one? What is the time of this wave relative to that one? So the size doesn't matter. It's only looking at pattern. Nobody's ever done that before. The people who make Elliott Wave programs, use proxies, momentum indicators to try to claim what the Elliott waves are. So I think we figured out a way to bypass the subjectivity aspect and the fact that the human brain can't handle all those calculations at once. And we've also fed 1,000 iconic counts into it, or maybe 2,000 iconic counts. Counts everybody agrees are correct and will never be changed. So the computer learned from those as well. So if anybody's interested, you can just read up about it because it's so much fun. His website is ewaves.com. Ewaves, spelled just like it sounds.com. And it's the coolest thing. And we've just started having our Flash analyst pull his recommendations off the E-Waves wave counts. And it's really cool. I could imagine if I were living another 100 years, having a company where there were no analysts, including me, and I would just have a good writer take a look at what E-Wave says and put it in print. But these are things I will never see, but it's really cool to see it having happened. So I think we may be overcoming that subjectivity part.
Oh, that's fascinating. And I can tell if there's anybody else out there trying to do something like this and you're looking to train your bot how to do waves. You've got two examples right here. That's where you want to be. I want to thank everyone for joining us today. We're incredibly grateful to Robert Prechter and Avi Gilbert for sharing their invaluable insights and for making this first ever joint presentation so memorable. I think I speak for everyone when I say that your expertise and perspective have truly inspired us. So thank you, gentlemen, so much. I wish you a great evening.
Thank you.
Thank you. I think when we're done here, I'm going to jump in my car. I'm driving up to Washington and get a swim in that pool.
It's a little too cool still.
Got to get in before it closes.
Yeah, that's right.
All right, gentlemen. Well, thank you all so much. It's been wonderful having you here. We are no longer live